All right. Hey, everyone. It's Paul with Investment Tuesday, and I am back, if only a little bit jet lagged. But we are going to do Investment Tuesday, and we are going to do a bonanza Investment Tuesday, looking forward again into 2026 with our against the grain forecasts, predictions, outlook. And yeah, I've got, I don't want to give it all away, but the 2026 roadmap right here. And I am going to lay it all out for you. And I'm only going to use two charts to lay it out. And I'm going to do it in this way. I'm going to talk about things that are going to make new all time highs, and then things that are going to make new 52-week highs. And these are going to be the big opportunities of 2026. That's my view. That's my view. But before we get into all of that, let's do the usual legal disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, our view, our take on the world. You use it as information, engagement, or entertainment. Whatever you choose to do with it, it is your responsibility because it is your money. All ATG Digital content may contain errors, oversights, and mistakes. Understand that investment operations, buying or selling an investment, have significant risks and can lead to the loss of your principal. Bottom line, you could lose money. I, the owners, employees, contractors of ATG Digital, we own, trade, transact in the securities that are mentioned in this video and all content from ATG Digital. We do not take money from company managements or crypto sponsors to recommend their stocks or crypto tokens for better and for worse. Our views are independent. Next, we publish an extraordinary amount of free research. The Substack goes out pretty much every market day. We do have these breaks in the year. For example, we are now, at least last week, we were closed for, Wednesday and Friday when the market's over. Nonetheless, mostly market days, Substack goes out. We've got the Bald Man Speculating podcast on Spotify, which goes out once a month. YouTube, I'm on every week, Investment Tuesday. Social media, active on X, active on Instagram and Facebook. Check us out over there at those links. Next, you can become a member of this YouTube channel. And what do you get for that? Well, if you become a member, you get early access to Investment Tuesday. So it comes on Monday instead of Tuesday. And then this week, I'm going to be recording a special bonus video for members of the channel, which will focus on one idea that is incorporated in this, what I'm calling 2026 roadmap. So only members get to view that, and generally it's a smaller company that just has, in our judgment, big, enormous upside. The other place you can go to get more of what you see on the channel is at atgdigital.media. Let me put the website up because it is important that you go to only that website, not something that looks like that website. Make sure it's atgdigital.media. And subscribe. Plans begin at $9.99. Okay. With all of that out of the way, hey, it's November. I'm recording this on November 30th. So December 1st is coming. And before you know it, December 31st will be here. And before you know it, January 1st will be here. We'll have gone from Thanksgiving to Christmas to New Year's. And, hey, I hope you all had a great Thanksgiving. And you know that from here on out, we're at the end game of 2025. So that means, if you're in the portfolio performance management game, that's what hedge funds are in. That's what most mutual funds and accounts, they're all measured by annual performance. What are they doing now? Well, what they're doing is cashing out their big winners because, hey, you don't want things to fall apart and then you lose all your gains. So they're cashing out big winners. There's managers being hired and fired. There's bonuses that are being planned, promotions that are going to be given out for spectacular achievements over 2025. And then, most importantly, people are already beginning to line up their bets for 2026. All right. And I think in 2026, people are going to, struggle with this, which is it going to be a continuation of 2025, which is what most people will simply assume? Or is there going to be some forks in the road? Forks, more than one, forks in the road. So here's my view of it, which is that I think this is going to be a year when it becomes really clear that the facts that central banks around the world are willing to accept 3 to 4% inflation really starts to push the prices of things that are hedges against that. Now, why is 3 to 4% a big deal? Well, it's a big deal because that used to be the benchmark. It used to be sort of like the threshold by which people judged whether or not there was inflation. I mean, 2% was like this, untouchable mark, right? I mean, a red line, if you will. And generally, central banks around the world would not lower interest rates if inflation was over 2%. But inflation has been over 2%, for a long time now. And the Federal Reserve is cutting, and the vast majority of central banks around the world are cutting. So the goalposts have been moved, and now we are okay with 3 to 4% inflation, which is not a high number. It's just way higher than what was deemed to be the standard, a couple of years ago. And big money investors around the world that, they leave large amounts of money in cash. They buy bonds. A movement of 1% in the, let's call it the standard, for inflation, or 2% is a big deal to them. I mean, if you compound 2%, loss to inflation, it's sort of like the silent destroyer of wealth, right? I mean, most people, counting on a day-to-day basis, be like, Paul, I don't know what you're talking about. I didn't experience any loss. My $100 is worth $100. Yeah, but your $100 is buying less and less stuff over time. The same $100 will buy less next year, less the year after, less the year after that. That's inflation, right? In other words, future money, is worth less than current money, right? So that's a big, 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 big capital allocation shift. What is capital allocation? Well, big money investors, like, when I work for, the hedge fund, I mean, before they, look to buy single stocks, like retail individual investors are very focused on what stock I should buy. But big money investors actually start to think like this: how much should I have in cash? How much should I have in bonds? How much should I have in stocks? Right. And then in cash, they might think like, well, in what currencies? Dollar, euro, Swiss franc, blah, blah. I want to diversify by that. And then if it's in bonds, it'd be like, okay, should it be in long-term bonds, medium-term bonds, short-term bonds? And then even in stocks, like how much in US, how much in international, etc. So that's called asset allocation, right? And big money investors leave, a lot of money in cash and bonds. And with the standard of inflation being loosened up, the goalposts being moved, where we are going to see, that silent loss of purchasing power through inflation, accelerate by 1% versus, or 2% versus what we have had over the last 10, 15, 20 years. That is going to cause a shift, right? And who's going to benefit? So that's really theme number one. I think 2026, I mean, we will see another set of what I think are going to be explosive moves in what are inflation, hedges. What's an inflation hedge? Well, so I'll put 3 up. Gold, I mean, most people think of that as an inflation hedge. Silver. Silver is a mixture. It's a inflation hedge, and it's also an industrial metal. I mean, it's used in a number of industrial processes. So it's an industrial metal, which I'm bringing this up for a reason because that matters. Because, yeah, I'll get to that. And then Bitcoin, which is in the middle of an enormous transition from being a pure speculative asset bought and sold primarily for price moves to where the new demand, the incremental demand that's coming in is buying it not for the speculative price movement. They are seeing it as a hedge against inflation. Now, people say, well, Paul, well, you're saying that and it's gone down. Gold hasn't gone down as much. I said it's in the process of transitioning into that. It's not all the way there. I would say it's probably 50, maybe 60% there. There are still a lot of people that are buying and selling Bitcoin for price movement. And that will continue, I think. But with each year, it will become slightly smaller and slightly smaller. And as a result, it is the people that are buying Bitcoin as an inflation hedge that are increasingly going to dominate the trading. And the speculative part of hey, Bitcoin's going to $1 billion tomorrow. Those folks become a smaller and smaller part of the market. So when you look at it in this way, and I'm going to remove myself so we can look at this 5-year chart that begins in 2020, because from my perspective, the beginning of this new investment world really begins with 2020. COVID happens. The central banks from around the world start just, pushing out money like you can't believe, which causes housing prices to soar, in the United States and not many parts of the world, causes stock markets to go wild, causes Bitcoin to go wild. And then, as it becomes clear that, this time around, right, that money issuance by the central banks is going to be inflationary. In other words, it's getting into the economy, it's getting into wages, it's getting into long-term contracts. Gold starts to take off, silver takes off with it. And so this is where we are at right now. So you'll see that, beginning 2020, I'm going to shut some windows down so I don't get frozen out by mistake. All right, so beginning here at 2020, you can see silver taking off, gold takes off a little bit, Bitcoin takes off a little bit later. Then everything sort of peaks out with the economy. We have that mini minor recession slowdown that kind of happens in 2022 and 2023. And then it looks like, well, maybe, the inflation will subside and go back to where it was pre-2020. No chance. And with that, we see gold prices starting to just rocket higher, silver prices going along with it, and Bitcoin going along with it. Yes, we've had a very large correction. This is, I believe it's part of the process of the washing out of the speculative money that is in Bitcoin. Those folks, every time there's a new high, they come in with leveraged bets. And then so when they get cleared out, institutional money that is, looking to put billions to work, they come in, scarf up that, cheaper supply. But nonetheless, going back to my 2026 roadmap, my view is this, which is that all three, gold, silver, and Bitcoin, will all see new all-time highs. All right. I mean, gold made an all-time high in 2025. Silver made an all-time high. Bitcoin made an all-time high. And all of them will make all-time highs in 2026 because of what I said, which is that you have now big money institutional investors that are like, hey, The goalposts on inflation have been moved. The value of money is going to be devalued by an extra 1 to 2% per year, which is a large amount when you consider that, people are keeping trillions of dollars in cash. I mean, that's a big loss. And they will look to protect themselves by buying into something that is finite, right? That is known finite, known as a store of value. That's gold, that's silver, that's Bitcoin, and it could also be Ethereum. I mean, I feel less sure about that, so I didn't put that into the chart, right? So that's like, I don't know, forecast, prediction, realization number one. 2026 will see a continuation of the scarcity rally. In other words, people seeking out assets that are scarce, and not just scarce in some, like, informal way where it's like, hey, we know this is scarce, or it has a long time record of being used as a store of value. Bitcoin, of course, you can monitor how scarce it is. You go on, the blockchain, you can see it. Gold and silver, it's known, what the scarcity is. Gold supplies increase by about 2% a year. Silver, maybe a little bit more. But nonetheless, all of these things will get money put into it. And because the game is on, meaning that the folks who own gold are not selling into new highs, right? The folks who own silver are not selling to new highs. So that means as new money comes in, they got to bid. They got to either get this additional 2%, new supply that is coming on, or else they have to find a price that is high enough that, the gold bugs, the silver bugs, the people that have been hoarding gold and silver are willing to give it up, cash it out, and go. So what's that price? I mean, my guess is for gold, it's probably well above 5,000. I mean, I have known a lot of people that love gold, and some of them will not let go of gold at any price. I mean, they're like, nope, this is it. This is my one asset. I put everything into it. Silver, I think there's probably more people that are willing to sell. And Bitcoin, one of the things that I've been writing about in my Substack and talking about how one thing that's different in the current sort of like crypto or Bitcoin cycle is that as Bitcoin has passed this 100,000 threshold, it has drawn OG miners, hodlers that have held on to Bitcoin from $1, $10, $100, $1,000. They're like 100,000 is enough, right? I mean, these folks have hundreds, if not thousands, of Bitcoin, and they're like, we don't need to get rich again. Yeah, they're making hundreds of millions, maybe a billion. So those folks are being slowly washed out. And then from there, Bitcoin is once again going to be similar to gold. In other words, there's not going to be a supply of enough people selling their Bitcoin, which means anyone coming in that wants to buy has to bid it out of anyone that's currently holding it to get any. So, all right, the scarcity bull market keeps going in 2026. All right, so that's forecast, prediction, realization number one. The way to participate in that is to buy gold stocks. If you're at ATG Digital, we've got, I think, 30 something gold and silver stocks. So we're already up, I don't know, 50, 60, 70%, even after the recent correction. So we're going to hold on to our gold and silver stocks. All right. All right. So next thing we're going to get to, which is, I guess, forecast, prediction, realization number two, which is that the reindustrialization of the West, right, is going to become more mainstream, more at the top of investors' taste palette for what they buy. What is reindustrialization? Quick and dirty, meaning of it. For the last 30 years or so, the United States, Western Europe, to some extent Japan, but essentially Western countries have shipped most manufacturing to places like China and with the idea that China was going to participate in this globalized economy. We buy from them, they buy from us. They make some things better, they make some things cheaper, we make some things better, cheaper, and there is this back and forth of trade. But it doesn't turn out that China wants to play that game. I mean, China essentially just wants to make everything. And I put up this post on X from an article that I saw, which I thought really gets to the issue with China. I mean, there's more than one issue, but let's get just sticking to the economics of it, which is, as this quote says, which is, there is nothing that China wants to import, nothing it doesn't not believe it can make better and cheaper, nothing for which it wants to rely on foreigners a single day longer than it has to. For now, to be sure, China is still a customer for semiconductors, software, commercial aircraft, and the most sophisticated kinds of production machinery. But it is a customer like a resident doctor is a student, right? I mean, if there's a saying in among doctors, they go through residency, which is that, I think, what does it say? You see one, you do one, and then you teach one. In other words, they buy the machinery, then they learn how to make it, and then, they're looking to sell it back to you. So then the question does become like, well, what do you make? What can you offer the Chinese? Because they, of course, have state subsidies and can, sell to you at a much lower price. They manipulate their currency, so it's much cheaper. So then there is the question of like, well, if the Chinese make everything, what will we sell them? Well, what can we give them? China is not a, let's say, it's not really a participant in the sort of globalization trade economy. What they're trying to build is sort of like a Noah's Ark, if you will, where they can do everything. They don't need anybody else. And eventually, not eventually, they're already starting to flex their muscles with rare earths, where they're like, oh, you say something about China, maybe it's on Taiwan or anything else, we will not ship you rare earths. So they are starting to flex their muscles, where China is responsible for something like 90% of all rare earth refining and manufacturing. So if they say they won't sell it to you, you're stuck. I mean, you can't, this is not something where you can flick a switch and, and open up a mine in a day or a week. It's not like, hiring a bunch of coders, right? I mean, these are very capital intensive, or very labor intensive, and very time intensive. It will take 5-7 years to open up a mine. So they can really, they got some market power here. And they have that market power in not just in rare earths, but in lots of areas, subcomponents. So the United States woke up to this threat, if you will, during COVID, when China refused to send a lot of different things here, everything from masks to ventilator parts, etc. And then we also saw the whole supply chain just blow up because China pursued a policy of zero COVID for almost 2 years, where you couldn't get any parts. So the United States woke up to that in 2021 or so. Western Europe is only beginning to wake up to this idea, and other parts of the world are beginning to wake up to this, which is that, there was never really a plan by China to actually become a full-fledged member of the sort of globalized economies where you participate, you give, you take, you buy, you sell. No, it was a sort of play for dominance. And this has the United States worried. This has Western Europe worried. This has Japan really worried. And so this gets to the second theme, which is reindustrialization. And I talk about this in my post, where I say US, Europe, and Japan are reindustrializing because China wants one-way coercive trade, buy from us or be without. And so reindustrializing means that metals, energy, shipping, manufacturing, cyclicals, in other words, capital intensive, labor intensive, all the things that stock markets generally have hated, despised, thrown away, don't want to own, and set aside, those industries are set to have a boom. That's my view. As I say, a post-globalization, re-industrial revolution is unfolding. New opportunities, new stocks will benefit. All right, so what are they likely to be? Well, it's quite easy if I just put up this one chart. Where are we likely to see this post-industrial reindustrialization boom? So I've got 4 lines here. Brown is for copper, black is for oil, gray is for natural gas, and green is for soybeans, right? Okay, so we've got a world right now where we're still in the China-centric world. In other words, commodities from around the world are all shipped to one place, mostly China, which takes those commodities and turns them into mostly some kind of finished goods, or parts that are finished enough that get sent to other places. In a world where you're going to have reindustrialization, you're going to have people start to make more things. Now, I'm not saying they're going to make every single thing, but they will generally think like, well, where does China have some kind of dominant position where they can hold it over our head, put a gun to our head and say, hey, yeah, you want this? Well, you will jump to our tune. And rare earths is a clear place where they are willing to put, willing to make good on that threat. And we will find out as the world goes through, during COVID, we find that out for just something as simple as face masks. The United States couldn't make it themselves. Parts for many medical devices, those are all made in China. So the Trump administration has made a priority list. I believe rare earths is one because important for defense, important for energy. Medical, pharmaceuticals, a lot of our pharmaceuticals are manufactured in China. So just imagine, they can say, yeah, we won't ship you the pharmaceuticals that you need. And then we'd be stuck rationing them. So this is another place where you are seeing factory boom, unfolding all over the United States as we're slowly bringing, some. I mean, you can't undo 30 years in a day or a week or a month. This is going to take a decade plus easily. So all of this is going on, and that is going to stimulate, what I've said is this cyclical boom, because when you put up a factory, you need a lot of copper. I mean, you need a lot of cement. You need, copper wires. Also, if you think like, well, I mean, those things won't just arrive at the plant. I mean, they got to be transported there. So you're going to use a lot of oil to transport them over there. Natural gas is, the primary fuel for electricity. You're going to use more of that. And in general, as the world sort of like understands that the China-centric global model is for now just splintering, but ultimately going to just, explode open, and where I believe we'll enter like a two-part world. One, you're part of the China-based sort of supply chain, or else you're part of the US-based supply chain. And there'll be some intersection in the middle where both sides, they can't do without each other, and they will, be forced to trade that. But other than that, we're about to see the old globalization world, come apart into these two things. And in that scenario, well, the US will have to stockpile copper. We will need more oil strategic reserves. We will consider, I mean, the United States is food self-sufficient, but other parts of the world are not. So every country will start to stockpile industrial commodities, agricultural commodities, and what that will do is start to put, like, yeah, money will start to go into all of these commodities and bid these prices higher, as people understand that, hey, we are now planning for a world where goods don't travel seamlessly from place to place like they currently do. Instead, the new supply chains are going to be dependent on which side you pick. Are you on the US side or are you on the China side? All right. And if you're on the US side, well, I mean, you'll have to be partially self-dependent, and partially, there'll be trade. If you're on the China side, they will make their own rules. They will say, hey, you have to accept our currency. You can't really make the things that we make. Maybe they'll allow you to, I don't know, make a few things. Not clear how the China-centric, the pure China-based trade bloc will present, but because we've never really seen one before. But we can see already that is going on, and the markets will start to move forward because the economies have started to do that. I mean, in the United States, I mean, there is a factory boom. Let me see if I can get I think this is yeah, there we go. Let me share this tab here. This is from one of my favorite sources of information, Wolf Street. Yeah, look at that. Construction spending for factories. Yeah, taking off in 2021, up 213%. It's come off a tiny little bit. That's because some of the uncertainty around, Liberation Day, what's going to happen, what is the final tariff situation going to be. But nonetheless, there is, a enormous boom that is unfolding that is going to absorb an extraordinary amount of commodities. And if you look at the last time there was a commodity boom, is just when China really put their industrialization project into, overdrive. So if you imagine that the United States, Europe, Japan, Korea, and all the others start to reindustrialize, well, we're going to need massive amounts of all of these things: copper, crude oil, natural gas, and also agricultural commodities. All right. Uh, Last thing I'll say on this as well: if you are closely listening to the news, you will hear the bells of war ringing. I mean, I was just in Asia um, over the last couple of weeks, and the amount of Chinese activity in the oceans around um, the Philippines and Japan has hit a new peak. I'm not talking for like the last 15, 20 years. The Chinese military and navy are aggressively pushing against all of the countries that are allied with the United States. There is an enormous, what's the right word? Crisis, if you will, that has erupted around the new Japanese prime minister, that has said that if the Chinese attack Taiwan, that Japan's interests would be threatened and they would take active part in the, I guess, the war that might unfold. The Chinese have come at her very, very aggressively. They have told Chinese people to not go to Japan for as tourism. Chinese people are a big source of tourism to Japan. There's social media content where some Japanese performers that are quite popular in China, Chinese censors are pulling them off the stage in the middle of their shows. So this has taken on a very nasty and bitter taint. And that is one, war, that is, people have talked about. And who knows? I mean, but we don't necessarily have to have a war, and I'm not rooting for a war, but if China continues its very aggressive positioning against Japan, against the Philippines, against Korea, well, I mean, all of those countries will start to rearm. And once again, you're talking, to rearm, you need all these industrial commodities. So people will start to stockpile all of these things. And my bet is that all of them, given all of these, put together, we'll see new 52-week highs. In other words, oil will see a 52-week high, natural gas will see a 50-week high, copper, other metals. I'm just throwing copper in there as a proxy for all the metal, agricultural commodities, shipping stocks, because you got to move this stuff all over. We'll see new highs. And these are the places where you want to be in 2026. This will come as, well, may not come as a surprise anymore. I've been sort of like sounding this theme, which is that AI is a bubble, it's a mania, it's too popular, it's over-owned, it's overvalued, it's, the expectations are wild. But meanwhile, this sector, everything that I've talked about, whether it be gold, silver, and even now crypto is now a somewhat unpopular sector. And then all these commodities, these are unpopular. These are against the grain. But the way you make big money is by doing something a little different. At turning points, you want to go to what is cheap, what is underowned, what is undervalued, and where new demand can really push prices higher. All right, that is Investment Tuesday for today. For those of you who are members, make sure to check for the bonus video, which I'll be recording after this, highlighting a single opportunity associated with the 2026 roadmap. All right. Thank you all for watching Investment Tuesday. This is Paul saying thank you and goodbye.